Happy New Year's, everyone, and welcome back to Lem's Cryptoverse. Since it's the new year, I got thinking, what did I learn on my crypto journey? I've been doing this, I think it's 2 years now. I have a lot of background in traditional finance and investments, lots of background really into it, but crypto was like this foreign object to me. So what did I learn? Apparently there was a lot to learn. Things that I thought I knew or that I was taught from people was not correct. And that's a scary thing. It reminds me of Pareto's principle. You know that 80-20 rule? Basically, 80%, actually it's more like 90% of the information I received from smart people on YouTube, on websites, whatever, Web 2, was crap. And that's the problem. You really have to rely on either people you really know and trust, or most likely you have to do your own research. So let's get started and I'll show you what I've learned. And some of these things you may say, oh, these are obvious, I knew that already. But I'm sure by the time I'm finished with this video, this is going to be something that you really didn't think about or something that you learned. And even if you didn't, think about me. I knew nothing and now I know so much more. And yes, I'm giving my weaknesses here. I'm showing you or telling you things I did not know that maybe you thought were obvious. But you know what? Let's just do this journey together and learn from it. So let's get started. The first one is that I thought each crypto moves idiosyncratically, meaning that they moved based on their own news events, how their roadmap was doing. I mean, like a stock, right? Like when Tesla, everyone knows Tesla. When Tesla comes out with any news, even slight news, maybe differences in production and what deliveries or what was expected, the stock makes a big move. You don't see that much in the cryptocurrency market. Everything moves together. And you can see here from Arcane Research, it's shown the 30-day performance of indices, Bitcoin versus large caps and mid caps and small caps. And you can see they've all moved the same over the 30 days. But it's not just the 30 days. It's from the get-go, from Bitcoin's, not really Bitcoin, but ETH's, I should say, first birthday. Ever since altcoins were invented, they've moved together. So this is going back many years. Next, I thought that all tokens and coins have a blockchain. It just made sense. Like, what's the point of having a coin if it doesn't have a blockchain? It just didn't make sense to me. Because the whole point of digital assets is that there's a software behind them. But that's not always the case. So let's talk about the differences, by the way. I thought coins and tokens were the same. They're not. Coins are cryptocurrencies that have their own native blockchain. So that's what I originally thought. But then there's tokens that have cryptos that utilize securities from another chain. And the prime example of this is ERC assets on the Ethereum blockchain. Those are called tokens. Next, I thought that closed-end funds that invested in digital assets, I thought they would move with the asset prices. Not one for one, not exactly, but somewhat close to the underlying asset prices. And that's nowhere near the case. And the best example is from Grayscale. Everyone talks about GBTC, right? How that's way off, that the net asset value is way off from what it should be. But look at this one here. This is Grayscale's Ethereum closed-end fund, and it's 69% below its net asset value. And over time, you could see the cumulative return. If you were really bullish on ETH and you bought the ETH asset directly, you would have made 379%. But if you bought the Ethereum Grayscale Trust, you would have lost 69% of your money. And this may not even be after those expensive fees. And as you know, fees are considered the number one factor why people lose money invested in mutual funds and hedge funds and whatnot. So this is a really big issue here, this discount that you're seeing in Grayscale. Next, I thought that cryptocurrencies weren't supposed to be correlated with anything. And so, you know what I did? I went on Google because now I found out, I realized that cryptocurrencies move with with liquidity and they move together with other assets. So what I was saying earlier is that I did a Google search on correlations of cryptocurrency. And even now, even today, when I typed in a Google search, Google spit out an answer for me in big, bold letters that said cryptocurrencies are uncorrelated. They're not correlated. So this is, in fact, totally wrong information. It's an incorrect narrative. It is totally wrong. And this is why people like me and other people lost money in crypto, because we thought it was a way of diversifying. And just a few months ago, even recently on Real Vision and YouTube and everywhere, there were people being interviewed. It's not just YouTube, but people being interviewed, the experts that are saying that crypto is uncorrelated. Again, this is a false narrative, and it's one of the most important points I want to make in this video presentation. Next, I thought the underlying blockchains were all the same. I thought basically everything was a layer 1. Not true. You got layer 0, which is Polkadot, Avalanche, Cosmos, I think Cardano. I'm not sure about that. Then there's layer 1, and these are the ones that we all think of, like Ethereum and Solana. God bless Solana. I hope they survive. And then you've got layer 2, and everyone knows about Polygon, Matic. And then you have something called layer 3. I'm not sure if this is the case. I just call them dApps. But the point is, I didn't realize that there was more than layer 1. And just one other nuance I want to talk about is there's actually a difference between layer 2s and sidechains. I thought they were the same. So layer 2s are different. They like from sidechains because sidechains have their own security. Next slide. Things that seem sexy and appealing to me, now I just think of them as big red flags. Like it was cool to have an anonymous team or pseudo-anonymous team like Ava Labs' Avalanche, and this is called they're called Team Rocket. But you know what? I'm finding problems with Avalanche. I feel like I cannot trust the Avalanche team because of that, and also because they've done some shady work. They said that they don't have inflation with their project is very inflationary, and they've also removed information on their website, on their blog about inflation. And then I thought I was really impressed by this vegan effective altruist, meaning you probably know what I'm talking about, Sane Bakeman Fried, SBF. I was really enamored of him, thinking that he's really helping the cryptocurrency industry. He's like the godfather, or some people call him the JP Morgan of today's cryptocurrency. Well, we know now with hindsight that was bullshit. High staking returns. I thought that was a great way of making easy money. It turns out it's not. You have to be careful of pooling operated risk. You have to be careful of the underlying chain. You have hacking and inflation. Here from staking.com, you can see the difference between what's called reward and adjusted reward. That difference, that's inflation. So always look at adjusted reward. Next, coins. I thought that coins were just used for trading amongst investors, buying and selling and speculation, when in fact, they do have many uses. Yes, these uses are small, but they're gaining ground. Some of the uses, as I just mentioned, are staking, and there's also, of course, fees and bonding. You see that with Polkadot, small contract lockups and NFT lockups, and governance and reduction of fees. And reduction of fees alludes to brokerages, centralized exchanges such as Binance and the now defunct FTX, which used the FTT token to reduce those trading fees. So I thought that DeFi was a killer app. I thought this from the get-go, from the beginning. I no longer think that. The problem with DeFi is that traditional finance, meaning Goldman Sachs, Morgan Stanley, JP Morgan, these finance companies and many other financial companies, they're pushing back hard because these are incumbents and they're facing disruptive technologies. So where I think the real killer app is going to be NFTs and dApps. It's not going to be traditional. I'm sorry, it's not going to be DeFi. DeFi is going to come up strong, but I think NFTs are where you're going to get the acceptance by customers, by users like you and me, number one. And number two, NFTs are not going to be seen as a threat to incumbent companies. Like, think of these companies like the whole consumer discretionary area. We're talking about a huge dollar value. I don't have it off the top of my head. Maybe I should have looked it up. It must be huge, like $100 billion. But I'm talking about companies like almost every company consumer discretion, like Lululemon, Nike. Think of Air Jordans. Think of LVMH with the usually expensive pocketbooks. And think of real estate. Everything is going to be authenticated and tokenized, and you'll be able to use them in games. So let me give you an example. You buy a handbag from LVMH. Is it LVMH? Louis Vuitton. You buy a handbag from them. That handbag is already authenticated using the blockchain, and you can use that handbag in the metaverse. That's what I'm talking about. And of course, you've got the creator economy with artwork and music and video creators. There's so much going on, and then you can slice and dice them. You can use it for trading. For example, let's say you have a subscription. When I said trading, I meant subscriptions. Let's say you got a subscription to something like Spotify, or let's just focus on that. You could actually sell your subscription so that you're using your subscription, maybe you only use it on weekends, right? And then the rest of the week, you can have someone else using it. I mean, there's so much you can do with the underlying technologies of NFTs. Stablecoins, they didn't make sense to me. To me, there was no use for stablecoins. Why not just use a US dollar? But in fact, it's much easier to conduct business using stablecoins than using the US dollar. For example, you don't get settlement delays. You get very little finality time. You get higher returns. You get exotic ways, I should say, of lending and borrowing. And then you get more of an increased network effect within cryptocurrency and blockchains when you use stablecoins. And lastly, as most of you know, stablecoins are what's used in decentralized exchanges like PancakeSwap and Uniswap. Last but not least, I thought that some coins would decline, meaning like 80 to 90% of coins would decline to zero. Now, I think it's even far worse. I think 99% of coins are going to zero. So I want you to think of these crypto projects like the portfolio companies of VC, of venture capitalists. That's all they are. We're at really an early stage for these blockchain projects. What else did I want to say? Regulation. I think if we had regulation early on, you wouldn't see this problem with all these coins going to zero. But the problem is there's been coins invented just for the main purpose of making money and trading. And there's been a lot of scams and scandals. I don't need to tell you all about that. Nearly 75% of the projects that I rated, I labeled them as uninvestable. Some of the projects that I rated before they became bust were Terra Luna, Celsius, and FTX. And there are far many more than that. So in conclusion, you need to do your own research and only trust a few people, even me. Check my work. And like Ronald Reagan used to say many years ago, before most of us were born, trust but verify. So let's continue on this journey together. Please don't judge me, and I won't judge you. And let's just learn from each other. And I think that's how we can grow together. Thank you all for listening, and have a great new year. Bye.